All right, good afternoon, everybody. Hey, what's up? What's up? Hope everybody had a good afternoon. Mine could have been better. All right. I didn't get a physical. It was a reference to another doctor for just like a minor little surgery I'm trying to get done. But I waited in the waiting room for 2.5 hours for my 1 p.m. appointment, and at 3:15 I was like, I gotta go. So I never, and at that time they told me it'd be probably over another hour, at least another hour to see the doctor. So I was just like, I'm out, whatever, see ya. So just wasted my afternoon. But I'm here, and there's no point in being in a bad mood anymore. So let's just get in a good mood. And I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is unchanged. Um, did trade Mara today. Got into and out of that. I was trying to not overly push it today for a number of reasons. One, I was kind of expecting chop in front of CPI, and two, is I knew I was going to be gone for a little bit today, so I didn't want to get stuck in any battles and then not be here. All right, how do we close? So the S&P is down 0.5%, the Nasdaq is down a full percent, and the IWM is flat. So we got a little bit of the mean reversion that we spent some time. Uh, but we had a little bit of mean reversion that we spent some time talking about yesterday, right? That difference between the Qs and the IWM is something that we really need to be focused on right now. And I'm really trying to figure out how that resolves itself. And for the most part, today's just one trading day. It is resolving itself a bit in a bearish fashion. So, what the heck is going on in this thing here? Sorry, just give me 1 second. Whatever. Um, So yeah, so the Qs, which was the most bullish chart, was down over 1% today, and the IWM, which is the most bearish chart, pretty much closed flat, which, if anything, continues the bearishness. We could take a look at the intraday price action. Overall, is a really choppy day. I have no idea what caused this big bump here at 120 with the volume and the spies that brought us to highs. Is that Apple related? Apple didn't move like that at that time. So did Qs go like that also? Yeah, Qs also had a bump on some volume there. No idea what caused that, but overall, the intraday price action was relatively choppy. We had a common gap down, and again, this is just another good example of gap analysis. So we spent some time talking about this yesterday also. We had a common gap down, and a common gap is just a gap within a previous range. So the only other real difference typically would be a breakaway gap, which is a gap above a resistance level or below a support level. Breakaway gaps tend to lead to gap and go situations. So most days when we're coming in the morning, we're looking at common gaps. Common gaps tend to get filled. What we talked about yesterday is that they don't have to necessarily have a full gap fill. Sometimes all you really get is that retracement to equilibrium, or even worse, you get some sort of time correction, or worse or better, depending on how you look at it. So this is a very common price action. It's similar to what we saw yesterday, only but the opposite. So we gapped down this morning. It was a common gap, wasn't huge. If I remember correctly, it was like 0.3 plus percent. So we had a quick little snapback off the open for the first 12 minutes or so, creating a pivot high into the ADMA, and that's where the market is no longer extended to the downside, and that's where you want to see, like, all right, there's that pivot high, you have your opening low. Which way does the market resolve itself from here? Do we break up a little bit further, in which case that then becomes pretty bullish, and you look for that gap fill, or do we eventually break that opening low, which then could typically be a little bit more bearish, and you could see continuation of the downside, especially if the big picture technicals are bearish, which they're really not, but they're starting to concern me a bit. So overall, just kind of a choppy day. Um, Again, we spent a lot of time in yesterday's afternoon meeting talking about the big picture technicals, so I don't think I need to spend as much time today. So just kind of an update on that is that there's nothing new. We have not broken the last potential higher low on the downside from the 7th, which is 442.75. If we break that, it's a problem. We haven't broken the last major pivot high for the market, which is 453 spot 67, which would be really bullish. We're somewhere in the middle. And we couldn't give continuation of that trend today, which is not necessarily the end of the world. But I'm also not surprised to see one big picture chop and big picture consolidation based on what we've spoken about previously and what I still feel the highest probability situation is here for kind of the month of September, but especially in front of CPI. We have CPI tomorrow morning. The CPI has really become, though I would say it's actually died down a little bit in terms of its importance and the way that it's been moving the market. The CPI overall has been the most important economic event each month that we have been getting it. It was giving hugely outsized trading sessions back at the end of last year. The low of October is actually marked by a CPI day, massive range that day, low of 348.11, high of 367.51, and that's just the intraday range. The pre-market range was even bigger than that because CPI comes out pre-market. I remember we traded down to like 345, I think, pre-market. So just a 20, $3 range if you include the um, pre-market price action for the October CPI event. And then I remember this is the October um, September. This is the October CPI event, which takes place in November. Also, huge move. The intraday move was $10, but that was after pre-market we moved $12. So that was another event where you had like a $22 SPY range if you include the pre-market price action. Just massive. December, I think this was it. December 13th was the November CPI day. It might have been the Fed day. I'm actually not 100% sure. I think it was the CPI day. And similar but different. On that day, we gapped up really big and sold off, and it was still a $12 intraday range. So beginning to slow down, and it's slowed down, more and more since those huge ranges that we had at the end of last year. But it's still one of the bigger market moving economic numbers and events. Everyone is paying attention to inflation. It's just so important for what the Fed is going to do. We're beginning to see a little bit of an uptick in inflation, but the market's expecting it. So what matters more is not necessarily if there's an uptick in inflation, but is the uptick in inflation more or less than what the market expects? We'll find out tomorrow morning. And the main reason why I'm even pointing that out and looking at some of those days historically is because economic events, fundamental events, they can have a significant change in your technical picture. And that's, by the way, that's why having an understanding, at least to some degree, of fundamentals is really important. Not so much so that you necessarily want to be like, Mike Wilson or Marko Kolanovic, who again I do have a lot of respect for their analysis, but if you purely were following their fundamental analysis, you would still be short from those October lows. Um, so that's why I think the technicals are most important in terms of how you actually position yourself and how you establish risk reward in the marketplace. But we need to understand that there are economic events and that fundamental changes to the economy or fundamental changes to really big companies like an Apple can completely change that technical picture that we're studying day to day of supply and demand. So, right now we're still holding that short-term uptrend for the small picture. The big picture is in an uptrend. The intermediate picture is kind of sideways here. We have the difference between the IWM, which has been relatively weak and is concerning, as it's sitting on the 200-day, with the Qs, which despite the Qs having a much weaker day to day and actually playing some catch up to the IWM, which by the way, we talked about it yesterday, it's usually what happens more often than not. A weak IWM eventually pulls down the SPYs and the Qs and not the opposite, though we have seen instances of both situations occurring over the course of the last, 2 years. And I keep saying, 2 years or a year and a half. And what I mean by that is, um, uh, the last time we were at all-time highs, the last time, basically the start of our bear market was basically the beginning of 2022, January 2022. So that's just a marker point for me in my brain that I keep going back to in terms of bigger assessments on the overall market. So if you go back to January 2022 or even a little bit before that, the IWM more often than not is the leader, meaning a weak IWM like we've been seeing now versus a strong QQQ. Usually it's the Qs that eventually get pulled down from the IWM, and not the IWM that catches up. Though again, there have been a few instances of the opposite occurring. So we'll see how that plays out. So far today, I think there's a win for the Bears because the IWM picture didn't get more bullish. There was relative strength in the IWM, but you can't look at this and say, "Hey, this picture got a lot rosier for the Russell." But the Q picture didn't necessarily get more bearish because we didn't break the low of September 7th, but it's certainly a day of QQQ relative weakness where that's catching up a bit to the downside on the IWM. But maybe tomorrow morning CPI hits and it's a big, miss or beat on those expectations, and we get a significant move higher or a significant move lower that then changes these big picture technicals to some degree or another. And I can't know what that's going to look like, obviously, until it happens. So that's kind of the market. As far as stocks go today, it was a really interesting day. Small caps woke up. The IWM had relative strength. Growth names were really strong today. What did TLT end up doing? Yeah, and that's with TLT being up, so that helps, right? Interest rates down a little bit, and the dollar up also, which doesn't necessarily help. This TLT still has a lot of work to do though, in order to actually get better. But it was interesting. Oh wow, ARM closed really weak. That's notable. But early on today, we had wow, GameStop failed all the way back down. Yeah, I missed the afternoon session, so I didn't really see a lot of this stuff. I didn't trade GameStop, but GameStop just ripping off the open. AMC, which was a focus of mine, actually not as bad into the close as GameStop was, but gave a really strong rip off the open, gave a secondary move to new highs, and then had a pretty weak close here. So I didn't really get the follow through that I wanted, and this ADMA is slowly catching up to price action, which deteriorates the reward profile on the bounce trade that I'm looking for in AMC. But it was a good focus, helped make me a few bucks in it. Mara, it was a focus this morning. We were looking at crypto names with Bitcoin gapping up so much, and pre-market, the crypto names were up a lot. We had discussed Coinbase. I didn't love Coin because it had that negative analyst note. It traded well off the open and then failed. We discussed Riot, also traded well off the open and failed. I guess kind of like a lot of growth. Mara was a focus for me. Mara was probably the worst one off the open. Maybe that had something to do with the information that Tom had provided in the VTF this morning about the dilution that they did just a couple days ago. Added some heaviness onto it. So it probably wasn't the best pick of the three, but no matter what, it gave enough of a move here where it sounded like everybody was able to more or less get their risk covered and make a few dollars before that trade actually failed. And that's how it was for me. I, was decently greedy on the upside with my position. So when the thing failed, I ended up small positive in it. Um, you never want to allow yourself, if you get this much of a move in a name, to ever finish negative in it. So I'm a big believer in that one-to-one kick that I talk about all the time to get your risk covered. And then from there, you can look to be a lot greedier, and that's usually when I become a lot greedier. But yeah, I was pretty greedy on this one, so I only made a little bit despite that move. So yeah, that was that. Made a few bucks in Unity, made a few bucks in Pinterest today, and kind of managed my open positions. And this WeWork went nuts for whatever that's worth. Um, WeWork is now trading above where it would have been prior to the stock split that it had. So big move on the biggest volume it's ever had today, which is really interesting. I think it's got a pretty big short float on it. The company's not out of the woods. So that's pretty much all I got. So don't have too much for everyone today, especially after we did the big update on the market yesterday. So Happy to answer any questions anybody has. So it could be a good day for questions. First thing I'm seeing here is from Fernando. Do you recommend that you close open positions before CPI? So I don't do that. I don't do that. You're definitely taking on some increased risk by holding positions into the CPI. But I have rules for swing positions where generally I'm only swinging positions that I'm already up in money in. Um, So what I'm risking in a CPI is basically giving back profits that I've already made if the event goes against me, but making significantly more if the event goes with me. So that's the type of gamble, for lack of a better term, that I like. Like I was just kind of saying before, even though I was just talking about basically a day trade with Mara, is that I try to be really really greedy with open P&L once I'm in a win-win situation. I've got my risk covered. I'm gonna make some money in the trade no matter what. That's when I want to be really really greedy and go for that outsized reward. And a lot of times that will mean holding positions into events. Where I do not like the idea of holding something into the CPI would be is if you have something that's against you. So the position's already against you and you need to manage risk on it, and now you're holding into an event where it could get significantly worse for you, or maybe you happen to make the loss back. That is the opposite, right? That's risking potentially a lot more to try to make your money back, as opposed to what I'm trying to do, which is risk money that's already been made in order to potentially make a lot more. So I don't recommend closing your positions out into CPI. I just recommend making sure that you're properly positioned into that CPI where you're not going to be in trouble if it moves against you. So thanks for the question, Fernando. What else, guys? Um, what's up, Mike in the YouTube? What else, guys? Happy to answer any questions that anybody has. So this is your opportunity. This is and I guess I'll just ramble a little bit while I give you guys some time to put any potential questions into the VTF that you might have. This is where we do our mentorship, right? So like I know a lot of people would love to get one-on-one mentorship. Um, like where I go over your trades every day or something like that, like every trade that you take, or spend some time with you on an individual basis. I can't do that, just because I'm directly managing over 100 traders. So it's not possible for me to really give any one-on-one direct mentorship. I'll always make myself available for people. If you really have any major problems or anything like that, or it's a more personal question or a more personal circumstance that you don't want aired out to everyone, I'll always make myself available for you. But this is the mentorship session right now, and the way that I like to structure that is um, to benefit everyone and also to be time efficient for myself. So it's up to you guys to not be bashful. I think that some people just get a little bit nervous to ask questions because other people are watching or listening, or they think their questions might be too beginner or too advanced or whatever. I don't want anyone to think that way. There are no questions that are too beginner. There are no questions that are too advanced. If you're asking a really beginner question and there's an advanced person that's listening, it's a great opportunity for that person to review their fundamentals. And if someone's asking a much more advanced question that maybe a newer trader won't fully grasp the answer, it at least begins to plant the seeds of some bigger picture concepts that that trader will eventually want to have a grasp of. So if you're happy with your trading performance, you want to take it to the next level, or you're not happy with your trading performance, this is what you got to make use of. You got to make use of these afternoon meetings. You got to make use of this Q&A portion that we do in every afternoon meeting. And as you guys know, I don't unless I really have to be somewhere. I don't mind hanging out till 5:30 or even later to get through everyone's questions to try to make these afternoon meetings as educational as possible. And I promise, if anyone's newer that's out there and you're bashful about asking a question, um, there's someone else that's out there also who's also being bashful about probably the same question. So any questions that anybody has um, benefit everyone. So don't be shy. And happy to see that there are some questions that are kind of populating in. So Rose is asking, can I go over how I like to trade the CPI? Sure. So for any major events that are affecting an individual stock or are affecting the market, I'm just typing up Apple to see if it actually moved at 1 o'clock today, and it really didn't. So I don't have a good example from today. Um, I always like to start by seeing the starting point. Okay, so I can try to assess for myself what I think is important from CPI. And I do that. And that goes back to just having a fundamental thesis for the market, which I think is something that's important for traders to have. So I'll see CPI hit and meet or beat or miss on expectations. And, I'll form a thought process around that, and I'll probably share that thought process. But more important than my thought process is the market's thought process. And how does the market show us its thought process around the CPI? By how it trades, if it's going up or if it's going down. So the number's going to come out at 8:30 tomorrow, 8:30 Eastern. I'm going to want to look at like 8:27, 8:28, a couple minutes before the number is going to hit and see where the market is trading. And in my mind, I mark that spot. And then I see, boom, all right, we move. And if we're trading above that spot, it means that at least in that moment, the market is interpreting the CPI event as bullish. If we're trading below that spot, the market is that's treating that CPI event as bearish. And now, very broadly speaking, and um, there are other factors to it. Very broadly speaking, um, if it's trading above the starting point, I'd rather be long than short. If it's trading below the starting point, I'd rather be short than long. Now, what we do see on a lot of these events, it's not unusual, and this is especially true at like a 2 p.m. Fed meeting when that happens, is in fact a lot of volatility and not necessarily a directional move. So you might take your starting point and immediately we trade up, but next thing you know, we're trading below that starting point. That's actually really important information also, because if the initial reaction is higher, um, and then we break that starting point, you know that every single person that just bought the market in that first 2 minutes or 5 minutes or whatever it is when we were trading higher is now out of the money. So a lot of times that actually leads to a reaction move to the downside. I was actually talking to a trader recently who has a trade that he likes to implement, which is actually, like shorting that starting point. If the initial news move was significant in one direction or the other, shorting that, if the initial move was higher, shorting that starting point because now you've got all these people that are underwater for like a quick scalp trade in the opposite direction if you're breaking the starting move in the other direction. And I like that. I like that concept. I think that having a good spot for a stop loss on that can be a little bit tricky. You can try to analyze like a percentage of the initial move or something like that as a stop loss. But at least conceptually, it sounds like a pretty good trade. Um, so that's broadly how I view and trade really any news event. And if I'm trading in the direction of the news event, which is preferable, meaning CPI hits tomorrow and we trade up, and CPI comes in way lower than expectation, so I really want to be long also. The appropriate stop loss that I would use is the start of the news event as well. And if you ever break that, then the market actually doesn't care, and they negated the event. So I hope that helps Rose. Just seeing Eddie sneaking in a clarifying question on that. So I'll answer Eddie's question and I'll go back to the top. Question: if I set a stop buy at higher or lower level before CPI data is coming out, would I get filled? Stops aren't going to work pre-market because they're linked to market orders, and market orders don't work pre-market. Um, you could, if you're super fast in the keys, potentially buy or sell immediately in the direction of the move. You just got to be very careful with that. You got to be very careful with that because you could get faked in a very quick move. Like we've sometimes seen moves where the uptick in the one direction before it goes in the other direction is like so quick that it's like literally a blink in the eye. and then of the eye, and then the robots bring it in the other direction. Um, so thanks Rose and thanks Eddie. Let me know on any clarifying questions there. Fernando, yeah, I record every afternoon meeting onto my YouTube, which is Derrick the Trader. Looks like Dave posted a link there, and you should give it a subscribe and give everything a thumbs up so that the algorithm likes what we do. From Bandit, thoughts on how to handle an unexpected market rip. I wasn't expecting the rip this AM. Trade it momentum style. Um, So, first of all, I would say that you shouldn't have not expected. I assume you're just talking about the move in the first 5-10 minutes here. It's a common gap down. So like I was saying earlier, an initial retracement higher should not be necessarily unexpected. It would be the first thing that I would say to you because that's typically how market gaps work. So this was very normal price action this morning. But I can say broadly, if the market gives a move in any direction at any time that is not something that you are expecting, it's first of all fine to sit on your hands and not do anything. If you have a specific trade that you're looking for that never triggers, or the market's moving in the other direction, or whatever it is, and something completely different than your expectations is happening, it is totally fine to sit that move out while you reassess. And in some ways, it's probably better to sit that move out because you're not prepared for it. And why do you want to just start jumping into trades when you're not properly game planned and not properly prepared? So that'd be one. Two is if you are able to adjust to the market move that you weren't necessarily expecting, you still need to have a technical trade to actually come in for you to trade, right? And we just talked about this in an afternoon meeting the other day. The definition of a trade is something with a technical reason and a technical out or stop loss. So we don't want to confuse layers of probability with trades. Layers of probability are influencing factors. So if you're able to be mentally flexible enough to adjust and say, wow, I wasn't necessarily expecting this, but we're really trending higher today, and I should be looking for trades in the direction of this trend. Okay, fine. Well, then you look and wait for trades in the direction of what the market is now telling you. But for like this opening move this morning, if you wanted to take advantage of those first 5 minutes and you were not expecting us to rip higher, I don't see anything to do there. I would just wait. And again, it's okay to miss moves in the market. It's impossible for traders to catch every single move that the market gives. So, and if you try to, you'll probably just lose money. So we have to learn to be comfortable with missing moves in the market, and that's totally fine. You're better off not trading than forcing things. From Nick, regarding risk reward dynamics, Pat and I were chatting about it a bit earlier. Do you ever change your out if you catch a big move? The risk changes after you get a significant move in price. No, I won't change my out really under any circumstances except for if I'm following my very specific trailing rules that enable me to change my out. I don't do that. What I'm more likely to do is maybe make a little bit of an adjustment in my on the reward part of the game plan, not the risk part of the game plan. So if I get a really big move in my favor and the market's becoming very extended, I remember in Roblox today, um, this move in Roblox today, I remember I sold some stock. I got a lucky fill. I sold some stock at 29.49, the highest 29.50, and I communicated it into the VTF. I was like, oh my gosh, this move is unsustainable. We're super extended here. Like I think for a lot of these growth names, and Roblox wasn't the only one that was doing this, we should really just be focusing on booking profit. And that might not necessarily be originally part of your game plan, but when you just look at this move, taking a little bit off here, especially this is not a news event, it's not on huge volume. Take a little bit off here. You're probably going to get an opportunity to rebuy that stock a little bit lower in the equilibrium area on a price or time correction. So I'm more likely to adjust the reward part of my game plan than the risk part of my game plan. Um, so that's how I think of it. Hope that helps, Nick. From Q saying, Palantir has seemed pretty strong lately. I think I noticed that you kept selling it when it ran. What was your sell trigger and not holding for longer? Well, I'm definitely holding a big position for longer, but I'm also trading around it. and trading around it while it's been in this range for a few weeks now, it's been very profitable. If I've just been sitting on a big position from $15, let's say, for the last, few weeks, and it's fluctuated between 14 and 16, I wouldn't be making very much progress. But the fact that I've been willing to trade around a heavier core position, which is a lot of what I do in all of my positions, it's enabled me to make really good money kind of day in, day out in Palantir, and keep pocketing some cash, and, selling higher and buying lower. Like yesterday, Palantir was kind of a conviction idea for me. I wanted this Palantir, it made my list. I wanted to break 1560 to 1570 and see if we could get a move to break that wedge to the upside. We got that. So I'm thinking in my head, in a best case scenario, we close at or above 16 yesterday, and that becomes a catalyst that leads to continuation, that gets this thing back to 17 or 18. Even as I'm thinking about it, I'm still selling stock into 16. One is because I could be wrong and this thing could stay in the range. That's kind of what it did. And two is because I still have a big enough of a core position where I'm going to make money on a move to 17 or $18. I will make money in a move to 17 or $18 in this thing. But I still want to trade around that core position in case we continue to range. It just, every single day here that Palantir has been going sideways, I've been putting more and more money in my pocket. So when you're talking about the Palantir stock that I was communicating that I was selling into this up move, that was stock because first, if you were listening, I said, hey, I'm rebuying some of the stock that I sold yesterday into the gap down. So I bought stock today at 1546, 1541, 1556. And then into this up move, I'm selling, right? I'm selling some of the stock that I rebought into that up move, and then I'm rebuying it again into this down move. I mean, here's my executions on it, right? You can see me buying some stock into the the gap down, and then selling stock the whole way up into this up move, and rebuying that stock into the down move, and selling that stock into the up move, and rebuying that stock into the down move. So that's why I'm doing that. And that's very consistent with what I do in most swing positions that I'm in. I want the move. Believe me, I want Palantir to go to $18. That's how I'm gonna make more. That's how I'm gonna make the most amount of money. But the truth is, if Palantir wants to keep ranging between 14 and 16 for the rest of the year, I'm fine with that also, because I'll make money in this thing every single day that it does that. Um, so yeah, that's the answer to your question. Excuse me. From Joanna, I've got one. Do you trade options often? No. And on what basis do you decide using options versus underlying for a trade? Risk management approach for options. So I traded options for the only time in my professional career in July and August, actually. Um, was the only times I've ever traded it. Options, the first thing I would say, and now I've taken them off my account for September just to save on market data and all that stuff, because why pay a cost for something I don't want to use? First thing I would say is just not where my edge is. I pay attention to options. I really pay attention to options information. That stuff that Pat posts in the VTF is gold. And I know that Chris, who I think made some comment somewhere here in this afternoon meeting, Chris like loves to identify some of that important options flow that he deems as unusual and kind of get involved with it. I think he's had a lot of success doing that as well. Um, for me, I utilize the option flow as a layer of probability for the market and for any stocks I'm looking at, or for seeing flow in the stocks I'm looking at. Uh, as options are becoming more and more utilized, they're affecting the market more and more. Um, the gamma squeezes that we saw coming into the market in the 2021 bubble were huge. So when you're seeing very consistent flow come in one direction for a stock or for the market, it's usually pretty telling that you're going to get that move. And like that's why I remember when we saw WeWork flow hit today for I think 650 and 670 calls, even though it was kind of smaller while the stock was still at $4.30. You don't see a lot of WeWork flow hit for that would be a rarer one. I'm not surprised at all to see that the stock went to 650 today, even though it's a huge, huge move for it. And I guess the wheat flow wasn't consistent, but that's kind of goes in the category of rarer flow. When it comes to consistent flow, the people that are on the opposite side of that are market makers, and market makers need to hedge out um, their exposure. So if there's a ton of calls going off, I'll never forget Tesla in like 2021, when there's a ton of calls going off that are really, really consistent, and you've got these market makers and dealers who are on the opposite side of that, they need to turn around and buy the underlying equity to hedge themselves out on the the call selling that they just had to do, and that buying helps to boost the market. So I pay attention to it, but I don't actually trade options. I traded some options in July because I wanted to gamble. Is really what it came down to. And if I was going to gamble, I wanted to gamble knowing exactly what I would lose if I was wrong. So I had a thesis going into the July earnings report that we were going to see more stocks trade lower than we typically do on average in an average earnings season. And I wanted to take advantage of that by being involved in just buying put options. And it turned out that the thesis was right, but my execution was poor. The first like five stocks or whatever that I bought puts in all traded fine on their earnings reports, and everything I bought expired worthless. Um, if I stuck with it throughout the entirety of earnings season, I was consistent, which is the key to any approach. I probably would have ended up making money. As it turned out, that my thesis was right on that earnings season, but it was really more in the back half of the earnings season that we started seeing the much heavier sell-offs on a lot of those reports. So I did that, and then while I was doing it, and while I was already paying for options data, I wrote some covered calls on some of these swing positions that you see that I hold for really long periods of time. Um, that I hold for really long periods of time, just to kind of make some cash flow on it. But the problem that I recognized with that strategy was that um, I had JD calls that I sold uh in July. I sold $40 calls. Um and then I was handcuffed in that I actually my game plan would have called for me to fully liquidate my long position in JD into $42. And I couldn't do that because then I would have been naked on the calls, and I guess I could have liquidated both sides of the position. But just the way the math ended up kind of working out was that even though, by the time the calls expired, they expired worthless, so they expired in my favor. The money that I made by selling them was less than the money that I didn't make by actually trading the position as per my normal game plan that I would have implemented. And then a similar thing was happening with a couple with S that I was in. And if I can't manage if I can't manage the position with like what I just did with we're looking at Palantir. I showed you guys my Palantir executions. If all of a sudden I'm unable to sell some of the stock because I'd be getting naked, and I can't take this sale up here at 1606 as an example, let's just say, and rebuy that stock lower, and maybe I miss out on the opportunity to do that multiple times, it's just not worth it for me. So I have no need to trade options at all. I have all the paper complete. So if I ever want to gamble into an earnings report again because I got a good hunch for it or something, I can just get it turned right back on. But I have no strategic advantage in doing it. I'm not going to come in and start trading complex options. And as far as being a directional options trader, I'd rather just have the equity. I don't need options for leverage because being a prop trader with T3, I get 20x my money or whatever to be able to trade the equity. So yeah, it's just not where my edge is. I don't have a need for it if you're asking me personally. So almost never, and it's probably going to stay that way for the foreseeable future. But there's plenty of people here on the team who are trading both. and are able to be really successful with it. I know Chris has some strategies that he implements. I know Eddie Vick has some strategies that he implements. So definitely worth it for you to have conversations with those folks to see what they're doing so that you guys can grow and expand with your option strategy. Which, by the way, so I'm doing a lot of ranting in today's afternoon meeting. I also want to say, talking about communication in the virtual trading floor, there's a lot of people in the VTF, especially in the beginning of the day when we're doing the morning meetings. There's less people when we do the afternoon meetings. Um, there's a lot of people who are in this VTF every day who almost never say anything, and whatever, some of you guys are bashful or whatever. I don't know. It's your own personal decision to communicate or not to communicate, but your communication helps everyone. And I think that some people don't like to communicate because they think that their strategies or their approach is too different from what I do, and that they don't want to communicate what they're doing because they do something that's so different. And I want to say, please don't feel that way. Communicate. Because again, there are people in here that I know are trading similar strategies, yet I know that you guys never communicate at all. And you guys could be at least communicating through the VTF to each other because you're implementing similar strategies and similar approaches, and help each other out. And I think there's a lot of value in that. And there's a lot of value in, even for myself. Like, I know what my edge is in the market, but I'm a student of the market. I'm trying to learn. So if you're implementing an approach that's different than mine and you start communicating about it, I'm probably not gonna tomorrow all of a sudden start, doing what you do. But I would love the opportunity to learn about what traders are doing, especially if they're doing it successfully, that is different from what I'm doing so that I can be a more knowledgeable market participant. There is so much to learn about trading. I'm still learning new things all the time. The big learning focus for me over the course of the last few years now has been a heavy focus on learning market dynamics, which is now something I talk about all the time. We get a lot of that in Pat's note. We get a lot of that from Bill K when he's here in the VTF. And a lot of that's related to options and stuff that we were actually just talking about. Uh, that's become a huge part of my learning process over the course of the last few years, and it's something I've really implemented into my trading, and it's really helped in a significant way actually add on to my trading success. And it never would have come on my radar to begin with if you guys weren't communicating it. Honestly, it started with Pat. Pat was the first person ever who, still when we were on the physical trading floor pre-COVID, was like, hey, I'm looking at some of this like gamma stuff, and I'm trying to figure out what it means. Like, are you familiar with it? And I wouldn't say I was fully dismissive at first, but I was like, oh, okay, yeah, whatever. Like I've heard so many things over the years. And then he just kept providing the information and providing the information and providing the large option information. And all of a sudden I was like, wow, this stuff actually really is affecting markets, and it's affecting the positions that I'm in. And I'd be a fool to not learn more and not pay attention to it. So communicate, communicate, communicate. It's key. Scrolling through here from Rex. I was swinging Tesla from yesterday. Okay. I got in at 263. Okay. Um, Yesterday, knowing that it's a breakout trade, so I held some of the position to swing, which is great because it closed at 273. It got a $10 profit cushion. So I closed some of my position to swing to look for a 290 target. I love it. This morning it pushed to 278 area, but then it kept grinding slowly and sold off under 270 today. Okay. I know the daily ADMA is still $10 away, but it also broke out on the daily, knowing that tomorrow we have CPI, with stopping under the opening low be ideal. You mean for today? I wouldn't if it was my position. I would stick with the original game plan that I put on for the trade when I decided to swing it. As you know, I'm a big stickler to creating a game plan and following that game plan like to the death. It's like no matter what, because I think it's just the only way to breed consistency is to consistently follow your game plans. And look, you could do it in a one-off situation because of a one-off situation like a CPI and stop yourself out early or whatever. I just think from a market psychology perspective, it's too easy to become a slippery slope to changing game plans all the time, and it's just not how I want to operate because then I'm not going to have consistency. So for me, I would be sticking with the game plan that I decided to have when I was keeping it overnight last night. For you, you can make your own decision on how you want to manage the position. So hope that helps. Scrolling through here, seeing Chris Ann. I really like to follow unusual options activity. It has been a focus of mine for many years, along with relative strength and relative weakness. Thanks, Chris. From Morgan, general question, but how do you think about setting stops? Seems the biggest mistake I've made is letting myself get shaken out of otherwise good positions. Sure. So, um, every trade that you take, by definition of it being a trade, has an appropriate stop loss that coincides with that trade. What I've learned over the course of my career, for me personally as a trader, and we need to understand ourselves, right? Because we have different personalities, and therefore different approaches work better for some people than others. Um, I like to utilize a stop in any trade that I take where I can feel very confident if my stop is getting triggered, that my idea itself was wrong. Usually that lends to, not always, but usually that lends to having to take a little bit more space risk on the difference between the entry point and the out than otherwise, but still having it being on an appropriate stop for that trade. Uh, in the past, when I've tried to utilize tighter stops, which can give you, there's an advantage to tighter stops. You can take more size for less space for the same dollar risk. And then more size, if that trade's working in your favor, means that you're going to make a lot more and get a much better risk reward. My problem is that if I'm using tighter stops, that might be appropriate technically for the trade, but I don't really feel that my idea itself was wrong. Then I tend to fight stock, and when I fight stock, I churn and I give back more P and L and lose more P and L than I would otherwise. So that's why, for example, just to give you an example, if we're talking about momentum trades, I'll take momentum trades sometimes where I really, really don't like on a 5 minute chart. Let's say I'm going long and the stock's moving higher, having a stop loss that's above the 80 MA on that 5 minute chart or whatever chart that is that I'm trading. Um, Sometimes you need to do that on pure momentum trades. You need to have that high stop loss and the 80 MA hasn't even caught yet. It's an earnings name, whatever, and you're just trying to trade momentum. Um, I have found that stop losses above an ADMA have a very high probability of shakeouts. And sometimes that shakeout isn't a shakeout, sometimes that's a failure. So I don't trade it well when I get stopped out when the ADMA hasn't been there because as soon as I see an uptick, I was like, oh, I was right, and I rebuy the stock. And then even if I'm right and then it goes up, I still got stopped out and rebought at a higher price, so that hurts my P&L. Or the idea is actually wrong, and picking my brain over a little bit of volatility, rebuying it higher, now taking a whole second loss or third loss on the trade. So I always want to make sure that my stop is appropriate for the trade. I know that the idea is wrong if I'm getting stopped out, and inherently that means that my stop is below the ADMA on any sort of with trend or with momentum trade. And again, it doesn't mean that I never take a momentum trade where I have my stop loss above the ADMA. I just really got to remind myself, hey, you're taking a momentum trade, you might get shaken out, and if you do, that's okay because that's the type of trade that you were putting on here based on where your stop loss was. So like you'll see me sometimes, and I don't, I always need to balance when I'm speaking to everyone in the VTF on what I do in practice versus what I actually think the right thing to do for most people is, because sometimes they're not the same answer. Um, like sometimes on a trade where I'm looking for this momentum to come in, the right stop might be just to use a momentum stop at the opening low, and I don't have a stop loss in, but I'm making sure that my size is appropriate because I'm waiting for the ADMA to catch up to price, or there to be some pivot low that coincides with that ADMA before I actually put that stop in, which technically means I've got some degree of unlimited risk when I'm initiating that trade. But then I need to make sure that my sizing is appropriate for that. And part of that circles back to, knowing who you are and knowing um, what type of account you're working with. Uh, Another thing that I'm very honest about, and it just is what it is. Trading a larger account has an advantage over trading a smaller account. You can do things from a game planning perspective, a sizing perspective, and from a risk perspective, trading larger accounts versus trading smaller accounts. Uh, I can have a small position. I could have 100 shares in an expensive stock and let it bleed dollars against me, and not even notice it. I won't bat an eye on it. But maybe someone who's dealing with a smaller account, they can't have 100 shares and let the thing go, $5 against them. All of a sudden, that's very significant. For me, that's just a feeler. I'm watching it, whatever. I'm down $500. I'm watching it. I'm gathering information. I'm waiting for a time to actually be able to execute and take size on it. So you need to know all of that information. What type of trader you are, what type of account you're working with, what risk is appropriate for you, and it to some degree dictates how you trade. And from a game planning perspective, being able to take more size because you can afford to do it has large strategical advantages from a game planning perspective on trades that actually work to any degree. I'll end up making money in trades where other traders are break even in, or maybe even take a loss in, just because I was able to take more size in it and have more game planning flexibility. Um, so I got off topic a little bit on your answer to your question, um, but I think that kind of covers it. Make sure you're using the right stop for the trade. A big mistake that people make is I want to have 1,000 shares, but I only want to risk $100, but it calls for 25 cents worth of space risk, right? So all right, I'm just putting a stop 10 cents down. 10 cents down is random. It's because you only want to lose $100 and you want to have 1,000 shares. The trade calls for 25 cents of space. So either take less size and give it the right room, or don't take the trade at all. Because if you take the full 1,000 shares and you risk the 25 cents, you're risking $250, not $100 like you wanted to risk. And you need to make sure that's appropriate. But it's more, you need to use the right stops. Stops are based on the market. It's based on what the market tells you. I really, really dislike random stop losses when traders use those. I'm just gonna buy this and I'm gonna give it 1%. I'm just gonna buy this and I'm gonna give it, 10 cents. That's random. The market doesn't care about that. You're asking to get shaken out of trades that work. From Rose Petals, can I give an example of how I piece into positions? Sure. So, um, it's going to be based on the game plan on the trade that I'm taking. Is the first thing that I would tell you. Most trades that I take, maybe not most, but a lot of trades that I take, if you're taking like a momentum trade, usually those trades call for taking all of your size at once. I'm buying this breakout, so I'm taking all my size all at once. I might leave a little bit of space to average down in front of my stop loss if I need to for position management on some sizing. But really, if I even have to do that, I'm already playing defense and the trade's not good to begin with. So the best momentum type of trades, and those really are my favorite trades. Breakouts are my favorite trades to this day. It's so simple, but when you got the right market environment for it, like we had for a couple months in June, July, they're the simplest trades and they're great and they work really well, but you have to have the right market environment for it. And those trades really call for just taking all your size at once and not piecing in. Um, Piecing into positions is more like if you're giving it a lot of room, or you're trading off of a support level, or like, a lot of times I'll talk about like um when we're doing the morning meeting and someone asks me about, I don't know, a stock, uh, based on the daily chart. The only information I have is the daily chart. And just one example, I just remember someone asked me about DraftKings on the 6th in a morning meeting. And I said, okay, it looks pretty good here. It looks above 30, like good above 30. So you could try to buy this through 30 or through this previous high of like 30.20 for momentum at the volumes there. Or you could look to build in versus yesterday's low. Um, Building in versus yesterday's low is definitely more swing trading, and it's daily chart stops for daily chart reward. And I don't love that as much. You hear me talk a lot about how I want to find intraday risk for daily chart reward. That's definitely my preference. But I don't have the intraday price action information to be able to provide the person asking that question in the morning meeting before the market's even opened. So all I can do is give you information based on the daily chart. So if you do decide to trade off the daily chart and you want to build in versus yesterday's low at 29.08 and the stock opens up at 29.65, then you should have a game plan where it's like, all right, I'm going to buy like an opening core position or a filler position at the open. So a lot of times what I might do is I'm going to buy a filler at the open. I'm gonna have a game plan to build in. I'll never be able to get too much size all the way down to yesterday's low of 29.07. So, whatever that's gonna be. If my first buy is 29.70, let's just say, and let's just use simple numbers. Let's say yesterday's low is 29.10, not 29.07. So I've got 60 cents worth of risk. So every 1,000 shares I take is gonna be $600 worth of risk. So, maybe I start by buying 1,000 shares and taking on $600 worth of risk, and then I plan to build in a little bit, and again, I can like $600 might be a lot to certain traders. For me, starting with $600 worth of risk on a trade, that's like that's not a lot. It's not normal for me. It is normal for me, or even more than that is normal for me. So, I might buy 1,000 shares there at 29.70, and I'm willing to build into the position and buy down some stock all the way down to 29.08. So I'm taking $600 worth of initial risk, but I'm planning on taking $1,500 worth of risk on the trade. So I've got a game plan built in my mind where I can buy more stock. My first buy is at 29.70. I might buy a little bit more at 55 and then at 42 and then at 27, and then at 15 is one last little desperation buy that hopefully yesterday's low holds, and that could be a game plan where I'm building in and I understand the full dollar amount of risk I'm giving it to that low. Or I might have that initial game plan in my mind, but really what I'm looking for is something on the small time frame to actually get heavier on and to then focus that risk off the small time frame. So I'm like, all right, I'm buying 1,000 shares here at 29.70, $600 worth of initial risk. I'm going to take $1,500 worth of risk if I have to build in all the way down to that low. But if I get an intraday signal, I might trade off that intraday signal. That's what I would rather do. So I'm going to size up versus that intraday signal. And then, maybe I now have the entire $1,500 worth of risk versus that intraday signal. And I take, a lot more size. And now my stop loss becomes tighter, or I take like a secondary trade. Now I have this core position, this core game plan where I will build down to 29.08 with $1,500 worth of risk, but I'm gonna now take this secondary trade here off this stop loss and add on an additional $500 or $1,000 worth of risk on this trade versus this tighter stop. And now if this thing really can work for me off that intraday signal, which again is the preference, I can have a lot more size with a better risk reward overall on what I was doing. Um, so that's one way in which I do it. And then a lot of what you see me do though is piecing back into stock, which goes back to the question asked earlier about Palantir, right? Why are you selling your stock at $16 if you think it's going to go to 18? Because I think it's going to go to 18, but maybe it doesn't. Or I think it's going to go to 18 and maybe I'm right, but maybe it doesn't happen for 2 more weeks. So I piece into and I piece out of stock around these core positions, and that enables me to generate cash flow while I wait for the bigger move to either work or fail. And that's what I was saying. I remember doing an afternoon meeting because we have all different types of market environments we have to adjust. Like I love this market environment in June, July where we're trading higher. This is my favorite. But I'll take this environment in April and May all day, and that I feel like was frustrating a lot of people, was this April May environment. I'll take that all day because my trades aren't failing. They're not working and really ripping higher and going to my targets. But while they're going sideways, I'll sell on the way up, I'll buy on the way down, I'll sell on the way up, I'll buy on the way down. I'll just do it all day, every day, and just put more and more cash in my pocket. And then that enables me to do a lot of things, that extra cash. It'll make my reward just better eventually when the trade works. It gives me more cushion if that trade fails, where I can stick to the original stop loss on a trade and make more money or lose less money than I would have otherwise. Or one thing that I've been doing a lot more recently and have been experimenting with, which we've also spoken about in afternoon meetings, is using the money that I make from the cash flow to lower the stop loss. The thing I don't love about doing that is it makes a stop loss random. And we already talked about random stop losses, but it lets me have more and more and more room. I remember using Unity as an example, and Unity just keeps letting me do that. Like I got in a momentum trade in Unity somewhere. I don't remember. I think it was this day. I think it was the 27th here. And I made a lot of money in it. And I think I got like all out of the position, and then I rebuilt all the way back in. I got all the way out of the position again. And let's say I made $10,000 in it. Um well, if my original stop loss, I think my original stop loss was meant to be 38 on that. Is 38, right? And at that amount, I'll lose $1,000. I don't know. Let's just make up simple numbers. But now I've made $10,000 in it. Like I can lower my stop loss by $9,000 on it, or I can adjust a game plan like $9,000 worth of P&L because it's my break even spot. So, and then I can adjust my game plan where instead of stopping myself out at $38, if it ever gets to that price again, I can actually continue to build in and buy more and piece in and piece out of stock around the core position. And every single time, let's say I'm doing that in 25-cent increments, every single time I get a 25-cent move on 100 shares, and it's an extra $25 in my pocket, and I can continue to creep and creep that stop loss down as I continue to play with more and more of, to use a gambler's term that I hate using, the house's money. And it's worked so well for me in some of these names. Um, like Unity, it's starting to be pretty good in, but like Snap as an example, like my average price in Snap is like I don't know exactly what it is. I'd have to go into my spreadsheets and do a little bit of math. It's like $3.20. Like Derek, how could your average price be $3.20 in Snap when the all time low is 5 back in 2018? And that's because I've made so much cash flow in Snap in this range that it's been in since this thing has been just ranging around $10 since July of 2022. That just by doing exactly what I'm talking about, and I've been talking about it more and more in these afternoon meetings just because it's been working so well. Um, my break even price is like $3 and change in Snap. So I can continue to implement the same game plan and piece in and piece out if I want to, all the way down to 3. Maybe one day eventually that becomes 0, right? How cool would that be? Then it's like, all right, I can just, buy and sell Snap every 10 cents down to 0 forever unless it goes up too much. Um, and just make more and more and more and more money like forever. Again, unless it goes up too much. So that was a very broad answer to your question because there's a lot of ways in which I am piecing into stock, whether it's core positions and I'm piecing in and piecing out, or it's a new trade like we kind of discussed and building a game plan around it. But I would say again, the core principles of everything that we're talking about is it's game planning and risk management. It's the math, right? The math is more important than your ability to read charts or your trades or your strategies or anything like that. It all comes down to the math. And the math is the of risk reward is found within the game plan that you create. It's the game plan that creates consistency, and that's what you need to focus on more than anything. So any trade that you're taking has to have a game plan, and that's why I like, if you're a brand new trader, not I like teaching breakouts as like a first trade to a new trader. Not only because in certain market environments, not all market environments, certain market environments, it's still a fantastic trade. It's also it's also very simple. You buy the breakout price. Your stop loss is the ignition bar low. You have 10 cents worth of risk. You want to risk $100. You buy 1,000 shares. Boom. It's so repeatable. And then create a game plan for yourself. I'm going to sell 500 shares at 1-to-1 to cover my risk. My other 500 shares, I'm going to, you know, trail 200 on a 5 minute, 100 on a 15 minute, and 200 I'm going to look to, piece out of into extension and rebuy into equilibrium with an understanding. It means that I might eventually lose that stock if things are working out really well, and that's a good thing. It's a good problem to have. All right, awesome questions. I love it. I love it. Let me just see if I missed anything in YouTube. Cyril asking, is real move coming usually later after a catalyst like a CPI? If we compare the IWM, SPY, QQQ, which one is more susceptible to price manipulation by market makers or hedge funds? Sure. So the first part of the question is the real move usually coming in later after a catalyst like the CPI? Not necessarily. Sometimes we see the real move starts at 8:30 the second the number hits. Your second question on indexes being manipulated by market makers or hedge funds. I don't really believe in that. Um, I don't really believe in the conspiracy theories about market manipulation. I mean, look, is there a degree of it that's true? Sure, but you'll drive yourself crazy trying to figure it out. You never will figure it out. I mean, we saw that with the gamma squeeze stuff they were talking about earlier. There was that one SoftBank person or trader or something who was potentially, uh, people were saying, not, I'm not saying, I'm not accusing anyone of anything, was utilizing the options market and a ton of their cash to manipulate Tesla and a lot of their stocks higher. Okay, fine. But what I really don't believe in, which people drive themselves crazy over, is that like a market maker knew where your little 100 share stop was and went and triggered it. It's no one probably knows, and even if they did know, no one cares where your 100 share stop is. Um, there are without a doubt algorithms that are built into the market that try to identify where stops are most likely clustered. That's just smart. It's also a math problem. If you look at a bull flag, right? You can just go on Google, how to trade a bull flag. Where should my stop be? At the low of the bull flag, right? So everyone that's looking at a bull flag has their stop at the same spot. This is why volume is important also, because it makes it more difficult for these stop finding algorithms to find your stop. But let's say you now you here you are, you see this bull flag, but you're not a little trader. You're a big, you're I don't want to use a name, but you're at some really big fund or whatever. You have access to a boatload of cash. It's just a math problem. How much how much money do I have to spend selling stock to drive the stock down to where the low of that bull flag is, where everybody's got their stop loss, so I can cover that stop loss of not just one person, but of a lot of people, and then come in on the other side of the market. Um, how much money will that cost? Is the risk reward worth it? What does the volume profile of the stock look like? And if the answers to that, it's not going to cost me a lot because the volume is pretty low right now. You can make money doing that. You just short enough to drive it down to that price, trigger the stops, cover your short, and potentially even try to go long into those stops, take everyone's stock, and then go with the actual real move of it. So hope that helps. From like I shorted the Qs at 10 a.m. to stop at the 9:55 high. I shorted the Qs at 10 a.m. to stop at the 9:55 high. Okay, so just a little pivot there. That we overshot that equilibrium zone and got up into that high there, um, in that spot. But yeah, I mean, nice spot because the candle wasn't a picture perfect objective upper wick. I had it lower on risk skew than I should have. I like that. Hindsight is easy. Um, any tips for the mental side of risk skew? I mean, what you did there was perfect. Understanding layers of probability, of course, helps, but it's definitely something I need to improve on. Yeah, I really believe that the key to countering bad trading psychology is good game planning. It's the key. Whatever your problem is, whatever your issue is, insofar as your psychology and your trading, um, the counter is always finding good game planning, right? So you build out game plans based on layers of probability. So if you've got your risk skew set in a specific way where it's just, hey, I take more risk or less risk built out over these layers of probability, just follow it. Just follow it, and then you don't really have to worry as much about the psychology aspect of it. But yeah, nice job there. All right, cool. Looks like I got through everything on YouTube. Looks like I got through everything on the VTF. Awesome. You guys made this a great afternoon meeting. I did not have a lot to talk about. If there were no questions, we would have been done by 4:25. That's when I went on that little rant. And we did a whole hour of questions. Again, your questions benefit everybody else in the team. So don't be bashful to communicate during the day. Communicate your trade ideas. Communicate what you're trading. Communicate how you're thinking about managing risk. You'll get feedback from me in real time. You get feedback from Pat in real time, from other traders here who are in the VTF who, are open to providing their opinion. It just makes all of us better. You put more ideas in front of everybody as well. So great stuff. From Dave, is 440 in SPY tomorrow if we gap down off the news too far? Not necessarily. So I don't know. Usually I ask Pat. If Pat's still listening, he might be able to tell us, or maybe somebody else can. Forever back when we were getting bigger CPI moves, I wanted to know what the options market was pricing in for that move into CPI, and I didn't ask Pat. We're probably not pricing in $6, right? Which is where 440 is. Lately, in the last few reports, I remember we were pricing in like a dollar, a couple dollars. Kate's saying three. So is it possible for us to get a move $6 to the downside to 440 tomorrow? It is, but if Tate's correct, then it's double what the options market's expecting, which can certainly happen if there's a big surprise on CPI, but it's relatively low probability. Open interest at 440 is high based on the chart I posted. Oh, I see. That's why I'm zeroing in on that spot. Yeah, I mean, I just look at the probability of moves into news entirely based on what the options market's pricing. So if the options market is pricing 3 and you're looking for a move at 6, it's double the move. So it's low probability, but certainly possible, especially when we have an event. All right, gang, I'm gonna wrap it up. Good stuff this afternoon. I hope everybody had a great trading day. We had some good ideas today, even if the market wasn't fantastic. And tomorrow morning is gonna be a big day with the CPI. So I'll see you all then. Have a great night.